Welcome back to Investing Talk Podcast. Today we're tackling a question quite a few of you have asked. Is Applied Digital Corp a good time to buy now? Before we really get into it, if you're enjoying these discussions, please do hit that subscribe button, like this video, and maybe leave us a comment. It honestly helps us bring more of these analyses to you. And hey, if you're feeling generous, you could consider buying us a coffee. The link's right there in the description. Also, really important, if there's a specific company you'd like us to look into, just give a comment below after we introduce the topic, and we'll definitely add it to our list. So our goal today is to cut through some of the noise, give you a clear understanding of Applied Digital Corp's current situation and, its future prospects. We've gone through a whole stack of recent sources, detailed stock reports, market updates, the lot trying to pull out the really important bits for you. Think of it as peeling back the layers. Okay, let's start right at the beginning then. What exactly is Applied Digital Corp, and, well, what's driving all this market chatter lately?
From what we've gathered, they're a significant player in digital infrastructure, data center hosting specifically. Initially more for enterprise and blockchain clients, but now they're making a really aggressive move towards AI.
Yeah, and what's really central to all that chatter is their revenue growth. It's been pretty consistent. Their Q4 and full year 2025 financials, which they announced back on July 30th, they really highlighted this trend. In fact, their Q2 earnings actually sailed past what the market was expecting. Revenue hit $38.01 million against an expected $37.12 million. And get this, their adjusted EPS, it came in at -3 cents. Now that sounds bad, but it was significantly better than the consensus estimate, which was predicting -16 cents.
Better than expected then, even if still negative.
Exactly. And if we sort of connect this to the bigger picture, a huge driver for this growth, and frankly the optimism around the stock, is their strategic expansion. They're moving into next generation solutions. We're talking specifically about the Polaris Forge 2. This is a really ambitious project, a $3 billion AI factory they're building up in North Dakota. It's expected to be operational by 2026, and this isn't just another data center, it's a massive bet. They're trying to position themselves right at the heart of this, burgeoning AI and high-performance computing space.
Okay, so consistent revenue growth, beating expectations on earnings, and these big, bold AI projects. It certainly sounds like a compelling story. But, as we often say, revenue is one thing, profit is another. When we look beneath that top line, what's the actual state of Applied Digital's financial health? Are there maybe hidden strengths or perhaps some concerns lurking that investors really need to know about?
Well, that really raises the crucial question about their margins. Because while the revenue growth is there, profit margins have been under, let's say, extreme pressure. This is largely down to very high operating costs and, of course, the ongoing substantial infrastructure investment needed for such an aggressive expansion plan. The latest reports show a negative EBIT margin, over -1,000%, and a pre-tax profit margin that's just, well, it's staggering, over -8,000%.
Wait, -8,000%, that's astronomical.
It is. These aren't just slightly negative, they're profoundly negative. It basically means for every dollar of revenue, they're losing like $10 in operating costs right now. This immediately flags the company as operating in what you might call hyper-growth, hyper-burn mode. It's a massive bet that future scale will eventually overcome these current colossal operational losses.
Okay, hyper-burn mode. That certainly paints a picture.
But to try and balance that out a bit, they do maintain a favorable quick ratio. It's 3.5. That's actually a strong indicator of their ability to meet short-term liabilities pretty efficiently. So that's a positive sign amidst all the cash burn.
Right, some short-term stability at least.
Yeah, and they operate with what seems like moderate debt. They're financing this big infrastructure growth with a mix of equity and debt, which, is pretty typical for a capital-intensive sector like this one. It's also worth pointing out they have a rather large share count, over 261 million shares outstanding. Dilution could be a factor down the line.
Okay, so we've looked at the fundamentals, the ambitious vision, that impressive revenue growth, but also those eye-watering negative margins you mentioned. Now, for what many investors see as the key question, what's the market actually saying about all this in terms of valuation? And how is the stock price itself reacting to this dynamic picture?
Right. Well, looking at recent market data, the stock has definitely seen some interesting action. As of August 22nd, it was trading around $16.55 per share. But then, just a few days later, on August 26th, reports showed it trending up, about 3.29%, climbing from around $13.66 that day. This recent uptick seems to follow some significant strategic partnerships and maybe some promising tech news that came out.
Okay, so some positive momentum recently. What about the actual valuation metrics?
This is where it gets really fascinating and potentially quite confusing if you're an investor. We have one source looking at data from around August 22nd, indicating that price to sales and price to book ratios are actually below or near the sector averages. The price to book was around 1.2.
1.2. That sounds quite reasonable, actually. Almost value territory for a tech-related stock.
Exactly. Suggests it's quite reasonably priced relative to its assets. But then, hold on. Another source, specifically reporting on August 26th, points to a robust price-to-book ratio of 8.43.
Whoa, wait. 1.2 versus 8.43. That's not just a small difference. That's a massive gap. How can both be reported around the same time?
That's the puzzle, isn't it? It's a fundamental split in how the company's underlying assets are being valued, or at least reported. It really highlights the importance of digging into the data sources.
Absolutely. It makes you wonder, are they using different definitions of book value? Maybe one includes intangibles differently or different future projections, or is it just timing? Effectively, if you're looking at this, you have to figure out which number, if either, feels closer to reality before you can even start assessing if it's over or undervalued. It's more than just a mixed signal. It feels like a foundational piece is missing or unclear.
Precisely. And yet, despite these really varying PB numbers, market analysts, on the whole, have generally showered the stock with favorable ratings. Craig-Hallum, for instance, they significantly raised their price target to $23, way up from $12. That reflects a very bullish sentiment on the data center space, especially citing what they called favorably priced transactions.
So the analysts are looking past the current numbers, perhaps, focusing on the potential.
It seems that way. And you also have institutional stakeholders like Jane Street Group owning a decent chunk, 5.5% of the shares. That also signals some confidence in the company's strategic direction, suggesting they see long-term potential outweighing these current concerns.
Okay, so analyst confidence, institutional backing. But what about the technical picture? For those watching the chart, what are the short-term signals?
Technically speaking, the stock has been kind of range-bound in recent sessions, basically bouncing between, say, $14.16 and $16.80. Immediate support looks to be near $14.50, with resistance up there at $17. The 50-day moving average is trending upward, currently around $15.40, which is generally seen as positive. And the RSI, the Relative Strength Index, is sitting near 55. So that indicates it's neither really overbought nor oversold right now, just kind of neutral. Plus, we did see a bullish MAD crossover in the last week of August. Volatility seems moderate, but possibly increasing, which suggests traders should probably be watching for momentum shifts, especially around news or the next earnings report.
This really does sound like a dynamic situation. You've got these significant growth drivers pulling one way, but then some undeniable red flags pulling the other. Let's talk about those potential speed bumps and maybe what could push the stock higher or lower from here. What are the key risk factors and the upcoming catalysts we should really be aware of when thinking about Applied Digital?
Okay, on the risk side, you absolutely have to consider execution risk. Building out these massive data centers and getting clients onboarded smoothly, that's critical, and it's complex. Delays or cost overruns could be very damaging.
Especially with projects on the scale of that AI factory.
Exactly. Then there's also their high exposure to crypto and blockchain hosting clients. That market is known for being extremely volatile, and lately it's facing increasing regulatory scrutiny in various places. That adds another layer of uncertainty. And another point that definitely stands out is the recent insider activity. August 2025 saw some moderate insider selling. Individuals like Richard Knottenberg sold around 13,686 shares on August 4th, and then Chuck Hastings sold 30,000 shares on August 12th.
Insider selling.
Yeah.
Never looks great, does it?
Well, the volume isn't necessarily huge. It doesn't scream panic selling or anything, but it is a data point investors should monitor, absolutely. It always raises that question. If the insiders are trimming their positions, what are they seeing that maybe the market isn't?
Fair point.
And of course, you always have the broader market risks. General market volatility, sector-specific risks like rapid technology shifts, those can always impact the stock, regardless of how well the company itself is doing.
Okay, so execution, crypto exposure, insider selling, market risks. Quite a list. What about the potential upsides, the catalysts?
Right, there are definitely clear catalysts on the horizon, too. Short term, the big one is probably the next earnings report. That's expected sometime in late October or early November 2025. And there's always the possibility of announcements, new contracts, maybe updates on data center progress or unveilings. Those often give the stock a boost. Longer-term, successful expansion into new data center markets could fuel significant recurring revenue growth, which investors love to see. And, M&A activity is always a possibility in the hosting space. Applied Digital could potentially become an attractive takeover target or maybe even an acquirer itself. Either scenario could be a major driver for the stock price.
So we've got these quite conflicting signals, haven't we? Impressive growth potential on one side, but significant operational hurdles. Those really puzzling valuation questions, insider selling. How do we reconcile all this into a coherent picture for someone considering an investment? What's the sort of overall investment thesis here for Applied Digital based on everything we've discussed?
Well, if you boil down everything we've gathered from the sources, the consensus kind of shakes out to maybe a 6 out of 10 rating for Applied Digital right now. The core insight really seems to be this. Applied Digital is a high-risk, high-reward play. It's essentially a bet on the future of AI infrastructure.
A bet, you say?
Very much so. Their early positioning in this rapidly growing space could pay off incredibly well. But the execution risks and the competitive pressures are immense. It's far less about current profitability, which, let's be honest, is non-existent right now, and much more about believing in that future potential.
So definitely not a widows and orphans stock.
Absolutely not. It's a highly speculative bet, not really a buy and hold for someone who's risk-averse. That recent insider selling, while moderate, does temper any short-term bullishness. And the valuation, especially if you lean towards those higher price-to-book figures we saw, doesn't offer much of a safety margin at current prices. Technically, as we said, the stock is kind of neutral to maybe modestly bullish, but it seems capped by that nearby resistance level around $17. So, for short-term trading, maybe suitable around earnings or contract news given its volatility. But for long-term investment, it's probably cautiously recommended only for investors who are already confident in the broader data center sector's growth and are willing to tolerate the pretty significant operational risks that come with a company in such an aggressive expansion phase.
Wow, what a comprehensive look at Applied Digital Corp. We've really tried to peel back the layers today on a company that's charging hard into the AI future. It reveals this fascinating tension, doesn't it, between that ambitious growth and some pretty significant financial hurdles. We've seen the excitement, the AI factory, those better-than-expected Q2 earnings. But we've also had to highlight the challenges. Those really pressured profit margins, the moderate debt, that insider selling, and of course, those truly intriguing conflicting valuation numbers, especially on the price-to-book ratio. So after hearing all of this, what stands out most to you? Is Applied Digital looking like a buy right now, or does it feel more like a situation that requires a very cautious, perhaps speculative approach? The journey into understanding a company's prospects is rarely just black and white, is it? It always seems to circle back to your own investment goals and, critically, your tolerance for risk. The big question for you, listening now, probably isn't just buy or sell, but maybe more like, are you willing to bet on this potential, even with the current lack of profit?
As one of our sources very wisely put it, the best trades are the ones you can make without emotion. Plan it, then execute it as if it's routine. But I think for a company like Applied Digital, that plan really needs to account for potentially extreme volatility. It feels a bit like a high-stakes gamble on the future of data, doesn't it? Where do you land on that spectrum? We really hope this exploration has given you plenty to think about. Thank you for joining us on Investing Doc Podcast. Don't forget to subscribe, like, comment, and check out those support links if you can. We'll be back soon with another exploration into the companies you want to know more about.